Welcome to the Tech Today podcast. It's your host, John Mayetta. And today we are going to get my reaction to Fed Chair Jerome Powell's talk at the FOMC meeting on Wednesday of last week. So here we go. Let's see what Jerome has to say.
Good afternoon.
Already, I don't believe him.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people.
That's not the Fed's mandate,
The
obviously.
economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news.
Problem is inflation's up
But
80%
inflation
over
is
2
still
years.
too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal.
And what's so significant about
Restoring price
2%?
stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy.
No, you're not.
Our strong actions have moved our policy rate well into restrictive territory.
1%
We've been
restrictive.
seeing the effects on economic activity and inflation.
Core inflation at 4,
As
Fed
labor
funds at
market tightness
5.5.
has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace.
No, it hasn't.
GDP growth in the fourth quarter of last year came in at 3.3%.
And if you back out real
For
price increases,
2023
GDP would be
as a whole,
negative.
GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions.
Strong consumer demand. That's not what B of A
Activity
says
in the
about the
housing
consumer.
sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong.
That's seasonally adjusted, and many of those ads are government
Unemployment
jobs.
remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers.
Non-seasonally adjusted jobs are
Labor
actually
force
down.
Participation rate has moved up on balance over the past year.
Labor participation rate is
particularly for
down
individuals
versus
aged
2019 and down
25
versus 3 months
to
ago.
54 years.
So he's spinning on labor
And
participation
immigration
as
has
well.
returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%.
Yeah, half the prices are up 80% to 100% over 2
PCE
years.
rose 2.6% over the 12 months ending in December.
Why can't we have deflation?
Excluding
Why is
volatile
2% a
food and
target?
energy categories, core PCE prices rose 2.9%.
If we increase productivity, prices ought to come down. That's what ought to happen in a healthy
Over
economy.
the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials.
It does.
Food,
And the Fed
housing,
causes
or
inflation with
transportation.
its incessant printing.
We're highly
So you're the
attentive to
guilty
risks
party,
that high
Fed.
inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion.
Yeah, after buying 120 billion of bonds each month during COVID.
On economic activity and inflation.
QT pales in comparison to
Decided
QE.
at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings.
And why not let Fed funds float? Let the market
We
set the
believe
rate.
that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
Gina Smilik from the New York Times. Thanks for taking our questions. Obviously, in the statement and just in your remarks there, you note that you don't want to cut interest rates without greater confidence that inflation is coming down fully. I wonder, what do you need to see at this point to gain that confidence? And as you make those decisions, how are you weighing recent strong growth in consumer spending data against the sort of solid inflation progress you've been seeing?
Sorry, say that last part again.
How are you weighing the growth data and consumption data, which have been surprisingly strong, against inflation data?
Okay.
This myth about consumer strength, it is nothing but a myth. Prices remain elevated. So it's not that people are buying more units of stuff. It's that prices remain elevated. So we live in a nominal world, and nominal prices are up. And that's what's supporting GDP, to the extent that anything's supporting GDP, is that the price of goods and services is up. But this notion that GDP is at 3.3%, GDP surprise to the upside in Q4, it's nonsense. It's pure nonsense. The way the federal government calculates real GDP, they are underweighting the impact, underestimating the impact of price increases. So the GDP deflator, which is supposed to remove the impact of inflation on nominal GDP in order to arrive at a real GDP figure. That GDP deflator is understated. In other words, the impact of price increases is understated when price increases are removed from nominal GDP. I believe if real world price increases for goods and services were backed out of the nominal GDP figure, real GDP would be flat or in negative territory. And I think that's been the case since 2022. We had nominal real GDP growth in 2021, given the amount of printing under both Trump and Biden. But that started to peel away in 2022. And I think this recession that we're in, I believe we're in it now. We've been in it since 2022, all of 2023, and it's about to get worse here in 2024 in March when the Fed allows its bank bailout, the Bank Term Funding Program, to expire. That's when banks are going to pull back on liquidity, and we're going to see the economy roll over. Liquidity is actually up Liquidity has been up since March of 2023 when the Fed rolled out the Bank Term Funding Program. And when I say liquidity is up, I'm talking about bank deposits plus retail money market funds. If you look at that, the combination, the sum of those two items, that sum has been growing since March of 2023. So I could argue the Fed has been easing since March of 2023 with this backdoor QE program, the Bank Term Funding Program. And now, of course, when they allow the BTFP to expire on March 11th of this year, they're going to replace that with the Fed discount window. And if you'll recall, the Fed discount window borrowing was at a record $152 billion in March of 2023, just prior to the Fed rolling out the Bank Term Funding Program. So when the Bank Term Funding Program expires, you're going to see discount window borrowing shoot through the roof. And I'm not sure the discount window is going to be enough of a lever to support banks. So I think you could very well see the Fed at the March 20 FOMC meeting or the April meeting drop Fed funds quite substantially to support the banks. So a lot of spin going on here. There's more that I wanted to say, and I'll just, it'll come up, and I'll say it as we move through the Q&A session here. So I don't agree with the premise of this question.
So what are we looking for to get greater confidence? Let me say that we have confidence. We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and has been increasing, but we want to get greater confidence. What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, sustainable path down to 2% inflation? That's the question. And the answer will come from some more data that's also good data. It's not that the 6 month data isn't low enough. It is. It's just a question of, can we take that with confidence that we're moving sustainably down to 2%? That's really what we're thinking about.
Further, I don't know who Powell thinks he's kidding. I mean, we've got $34 trillion in outstanding debt. We can't maintain elevated rates in perpetuity, given the cost of servicing that debt. It's going to be at approximately $1 trillion this year. And the way Congress and Biden are spending, I mean, we may spend close to, if not at, $8 trillion this year in fiscal 2024, which ends October 1st. And so on $8 trillion, if you assume taxes are sort of flat this year, because I think, again, the economy is going to roll over and tax receipts could be flattish or down. Let's just say they're flat, which would be $4.5 trillion of tax receipts on $8 trillion of spend. I mean, we could be looking at a $3.5 trillion deficit. And so as Treasury funds the spending, and we're using a very expensive spending model this year, whereby we don't have a sort of a full year budget. We're doing these continuing resolutions, these 90-day short-term plans. And the most recent one was a 1.7 trillion plan. It's a very expensive way to fund the government. And so as Yellen issues treasuries, I don't believe that private investors in sovereign nations are going to be able to absorb everything that Treasury issues. So the Fed at some point here is going to have to step in and start buying treasuries again to help subsidize fiscal spending. So this whole notion that the Fed is in control of the economy, of the markets, is nonsense. Sure, they have crowded out private capital. Sure, it's the biggest player in markets, but at the end of the day, the Fed is the lapdog of Treasury. I mean, it used to be independent years and years ago, decades ago, but since 2008 in particular, with that initial QE program, the Fed has largely become the source of funding, the lapdog to Treasury. That's become its primary purpose. It's not there to create a stable pricing environment or full employment for the economy. That's not the Fed's mission. Powell's full of it.
In terms of growth, we've had strong growth. I mean, if you take a step back, we've had strong growth, very strong growth last year.
Nonsense.
Going right into the fourth quarter.
Nonsense.
And yet we've had a very strong labor market, and we've had inflation coming down.
Also in the labor market, as I mentioned earlier, and I kind of talked over Powell when I said this, but labor participation, the labor participation rate was flat in January with December. And those 2 months were down from the previous month. And if you look at where we are now in terms of labor participation, we're below where we were in 2019, just prior to COVID. End of 2019, Jan 2020, Feb 2020, we're below that level. So less people are being productive today than just before COVID. And then if you look back to, the year 2000, where I think the number is 66% and change. Don't quote me on that, but we were multiple points higher in terms of productivity rates 20 years ago, and prior to that, even more so. So it's just fewer people are being productive, and fiscal and monetary policy is being used increasingly to subsidize consumer spend. I mean, Treasury and the Fed really represent the nanny state. And subsidizing consumer spend with these various welfare programs and such, which are approximately 60% of all fiscal spend, it devalues the dollar with every dollar that's printed. So purchasing power continues to weaken with every dollar of wealth transfer. So that's the name of the game, really, is wealth transfer.
So I think, whereas a year ago we were thinking that we needed to see some softening in economic activity, that hasn't been the case. So
all these corporate layoffs this past week with earnings calls, which he's fully aware of. How did that not soften the labor situation? Nonsense, Powell.
We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months.
And I'm sorry, if I could just follow up very quickly. When you say that you want to make sure that it's a true signal, is there anything that you're seeing in the data that makes you doubt that it's a true signal at this stage?
No, I think I would say it seems to be the likely case that we will achieve that confidence, but we have to achieve it, and we haven't yet. And so, I mean, it's a good story. We have 6 months of good inflation, but you can, and you know this, you can look behind those numbers and you can see that a lot of it's been coming from goods inflation, for example, and goods inflation running significantly negative. It's a reasonable assumption that over time, goods inflation will flatten out, probably approximate zero. That would mean the services sectors would have to contribute more. So, in other words, what we care about is the aggregate number, not so much the composition. But we just need to see more. That's where we are as a committee. We need to see more evidence that sort of confirms what we think we're seeing, and that tells us that gives us confidence that we're on a path.
Yeah, and he's right. Services inflation has been very sticky. I don't know why he believes it's magically going to come down, those numbers. I don't believe that 2% is this magic number. I believe we ought to have some price deflation, given that if you look at price increases since 2021, depending on the category, we could be talking about 50, 75, or 100% price increases or more, depending on the asset class or the specific good or service. What's wrong with price deflation? Right? I mean, if we increase productivity, and one way to do that would be to cut tax rates so that companies across industries are incented to produce more. If we produce more and do so at scale, prices ought to come down, which will result in price deflation. What's wrong with price deflation? Don't we have the right to ask for price deflation, given the massive price increases we've suffered since 2020? Inflation is the tax that doesn't discriminate. It's the tax that we don't get to vote on. And Powell speaks, and it's pure spin, but he speaks as if getting CPI down to 2% is a win, despite the fact we had that massive step function up in price increases over the past 3 years. How is that a win? Walk me through that. He can't, obviously.
To a sustainable path down to 2% inflation.
Nick Timmeros of the Wall Street Journal. Chair Powell, it seems to me you raised rates rapidly over the last 2 years for two reasons. One was the risk of a wage price spiral. Two, there were risks of inflation expectations becoming unanchored. This morning's ECI report for the fourth quarter shows private sector payroll growth running at a sub 4% pace, Inflation expectations are very close to where they were before the inflation emergency of the last 3 years. And given that you appear to have substantially cut off these two tail risks, and that you've judged here today current policy is well into restrictive territory, what good reason is there to keep policy rates above 5%? Are you really going to learn more waiting 6 weeks versus 3 months from now that you have avoided those two risks?
So, as you know, almost every participant on the committee does believe that it will be appropriate to reduce rates. And for partly for the reasons that you say, we feel like inflation is coming down. Growth has been strong. The labor market is strong. What we're trying to do is identify a place where we're really confident about inflation getting back down to 2%, so that we can then begin the process of dialing back the restrictive level. So overall, I think people do believe, and as you know, the median participant wrote down 3 rate cuts this year. But I think to get to that place where we feel comfortable starting the process, we need some confirmation that inflation is in fact coming down sustainably to 2%.
I'll stop it there. And so when the Fed does ultimately cut, they're going to cut quickly. So when they see what I think will be the likely catalyst for the Fed cutting will be the banks having difficulty once the bank term funding program is pulled away, and some of the smaller banks that are less well capitalized having liquidity issues and frankly failing. And once those headlines start to hit that we have bank failures, then consumers are going to start to pull deposits out of banks, and that could cause a liquidity crunch just like we had in March of 2023. And you'll see the Fed cut rates, and when they do so, they'll cut them pretty quickly, because what they'll want to do is the Fed will be trying to, with the rate cuts, reinflate the bond values in terms of the fixed income instruments that the banks are holding as assets. And by inflating the value of those holdings, the bank holdings, those banks will be able to borrow more because the value of the collateral will be higher. And in borrowing more, they'll have more liquidity to meet depositor demand. But as it stands now, the banks have suffered massive unrealized losses on their debt holdings. That number is at $684 billion at the end of the September quarter. The FDIC hasn't published numbers yet for the end of the December quarter. I believe the losses narrowed a bit as of 12/30 because yields had started to come down, and yields have since gone up and come down again since then. So suffice to say, the banks still have hundreds of billions of unrealized losses on their balance sheet. And then the other thing I wanted to mention about payroll, the way a lot of these payroll numbers are calculated is they're the government will collect data from large companies, but then they apply a model for what's going on with smaller companies. And so that number is sort of imputed. And if you look at the imputed number, those figures have been growing, but yet the actual reported figures from large companies show payroll coming down. So I don't buy this whole notion that payroll is up. And even if you look at the the figures that came out, the jobs figures that came out on Friday, if you just look at the non-seasonally adjusted jobs numbers, those numbers were down sequentially, December to January. So I don't buy this whole notion that the jobs market is strong. And I've just sort of decided I'm not going to do the full Q&A session for Powell, because I've already listened to it once. And as always, it's all spin. And I don't know that there's a lot of value, frankly, in listening as an audience member to all of Powell's comments, because frankly, all of it requires that you read between the lines, because all of it is spin. None of it is just 100% the full truth. He's paid to spin. He's paid to lie.
I could ask differently. If you hold rates high as inflation moderates, as it has been, target rates will exceed the prescriptions of the Taylor rule or its variants.
Powell's not looking at the Taylor rule. He ought to be, but he's not.
Than the levels recommended by those rules. in the current instance?
Well, look, I think, as you know, we consult a range of Taylor rules
Yeah,
and
sure you do.
non-Taylor kind of rules. We consult them regularly. They're in our teal book, and they're in all the materials that we look at. But, you know, I don't think we've ever been at a place where we were
This
setting
time's
policy
different.
by them.
The old rules don't
depending on
matter
the
now. This
rule,
time's different.
It will tell you
Okay.
different things. There are many different formulations. Another way to think about it is implicitly is so. In theory, of course, real rates go up if holding all else equal as inflation comes down. But that doesn't mean we can mechanically adjust policy as real rates, as inflation comes down. It doesn't mean that at all because, for one thing, we don't know. We look at more than just the Fed funds rate. We look at
Why not let the
financial
market
conditions.
set
But in addition,
the
we
rate?
don't
Why
know
do we
with
need a
great
central
confidence
bank
where the
arbitrarily
interest rate
setting
is at any
Fed
given time.
funds?
But that also doesn't mean that
Let the
we
Fed
wait
flex the
around
money supply,
for,
larger or smaller. But as
to
far
see,
as the
you know,
rate,
the
let the
economy
market
turn down,
set
because
it.
that will be too
That's the
late.
answer.
So we're really in a risk management mode of managing the risk, as I mentioned in my opening remarks, managing the risk that we move too soon and move too late. And I think to move, which is where almost everyone on the committee is in favor of moving rates down this year. But the timing of that is going to be linked to our gaining confidence that inflation is on a sustainable path.
No, there's enough evidence that the economy's softened enough to where the Fed could take rates down. He's being political. He's afraid that the Fed takes rates down and fiscal spending ramps and then inflation ramps again. That Powell's afraid of being viewed as Arthur Burns 2.0, the Fed chairman that famously took the pedal off the metal too quickly as it relates to tightening. So Powell was slow to recognize inflation, kept printing. If you recall, the Fed was buying 90 billion of treasuries a month and 30 billion of mortgages a month, right through COVID, right through all 2020, 2021 into May of 2022. So the economy had long stabilized prior to Powell putting the brakes on QE. I mean, you could argue the economy stabilized in 2020, and there he was through all 2020, 2021, in the first half of 2022, behaving as if the economy was in crisis. And he was exercising QE at a level that had never been seen before. And if you recall, QE was supposed to be a one-time event back in 2008-9 during the financial crisis. But instead, we got a permanent policy, right? What's the old saying? There's nothing as permanent as a one-time government policy. And that's his real fear, seeing inflation increase on his watch again for a second time. And I don't know how he's going to avoid that, frankly, because the $60,000 question is what will the Biden administration do this year in an election year? Right, we're going to see more helicopter money. We saw it once in the Trump, once in the Biden. I think we could so very well see it again. I could see Biden doing something around the June, July timeframe called a 4th of July, Make America Strong, mail out helicopter money program. And he's going to Powell will fall right in line if that happens. He'll be right in line subsidizing that fiscal spend, that helicopter money drop. And he'll be right back at it, helping to usher in the next ramp up in inflation. And, with that, I'm going to stop here because, frankly, I can't stomach any more of Chair Jerome Powell. So that's all for now. See you next time.